Imagine walking a tightrope, knowing the mechanics of balance, understanding the physics, yet still feeling the tremor of fear in your legs. That's investing. We meticulously analyze balance sheets, dissect market trends, and construct elaborate financial models. But often, unseen forces tug at our discipline, threatening to send us tumbling. These are the psychological traps, the silent saboteurs that lurk within our own minds. They are like hidden fees in an investment, unseen at first glance, yet steadily eroding your returns. Benjamin Graham, in The Intelligent Investor spoke of the margin of safety, that crucial buffer against the inevitable uncertainties of the market. But what about the margin of safety against ourselves, against our own biases? This isn't just about knowing the rules of the game, it's about knowing yourself in the game. Are you aware of the subtle ways your emotions hijack your rational thought? The comforting illusion of control, the seductive pull of the crowd, the sting of regret that clouds your judgment. We're not just talking about abstract concepts here. We're talking about real money, your future, your peace of mind. This is about arming yourself with the knowledge to recognize these traps, to understand their mechanisms, and to develop practical strategies to diffuse them. Because discipline isn't about cold, robotic detachment. It's about self-awareness, about understanding your vulnerabilities, and building a resilient framework that can withstand the inevitable storms of the market and, more importantly, the storms within. What if the greatest risk to your portfolio isn't the market itself, but the person making the decisions? There's a subtle whisper that often accompanies success, a quiet voice that says, "You've got this, you understand the market, you know better." This is the siren song of overconfidence, the certainty illusion that lures even seasoned investors onto the rocks. It's not about lacking skill, it's about overestimating it. It's about mistaking a lucky streak for innate genius, leading to excessive trading, reckless baits, and a dangerous underestimation of risk. Data consistently reveals a stark truth. The more convinced investors are of their own brilliance, the poorer their returns often become. How many times have you dismissed a dissenting opinion, trusting instead in your gut feeling? Intuition has its place, but in the cold, calculating world of finance, it's a treacherous foundation upon which to build your future. The market doesn't care about your feelings. It responds to data, to fundamentals, to the relentless logic of supply and demand. So, how do you silence that seductive whisper of overconfidence? By embracing a practice of ruthless self-assessment. It's called calibration. Track your past predictions, meticulously documenting both your rationale and the actual outcome. Did your analysis hold water? Were your assumptions valid? Where did you go wrong? Overconfidence is like driving a car at top speed with your eyes closed. You might be a skilled driver, but your awareness of your limitations is what will truly keep you safe. Are you willing to open your eyes and face the road ahead? Or will you succumb to the illusion of control, hurtling blindly towards avoidable losses? The market dips, a wave of anxiety washes over you, your heart races, you see red. This is loss aversion, the primal fear of pain that grips us far more powerfully than the anticipation of gain. It's a visceral reaction, a deeply ingrained survival mechanism that can wreak havoc on your investment decisions. This fear manifests in predictable ways, clinging to losing investments, hoping against hope for a turnaround, while prematurely selling winners, eager to lock in a profit, however small. It's a self-defeating cycle, fueled by the irrational desire to avoid the immediate sting of acknowledging a mistake. You've likely heard the mantra, cut your losses and let your winners run, but what if that loss is a fundamentally sound company temporarily caught in a market downturn? Blindly adhering to this advice can lead to selling undervalued assets at precisely the wrong time. A more nuanced approach requires a deep understanding of the underlying business, a willingness to challenge conventional wisdom, and the discipline to hold firm when others are panicking. The key lies in mental accounting. Instead of viewing each investment in isolation, consider it as a single piece of a larger, diversified portfolio. This broader perspective diminishes the emotional impact of individual losses, allowing you to make more rational decisions based on long-term goals. Loss aversion is like a phantom limb, a persistent ache that reminds you of a past injury. Acknowledge the pain, understand its source, but don't allow it to dictate your movements. Don't let the fear of loss paralyze you, preventing you from seizing future opportunities. Are you investing for the long term, or are you simply reacting to the fleeting emotions of the moment? The allure of the crowd is powerful. There's comfort in knowing you're not alone, security in the shared belief that everyone else is doing it, but in the world of investing, this herd mentality can be a path to financial ruin. It's the force that fuels market bubbles, inflates unsustainable valuations, and ultimately leads to devastating crash. Think back to the dot-com bubble, the housing crisis. In each case, a collective frenzy swept through the market, blinding investors to the underlying risks. Driven by fear of missing out, they abandoned rational analysis, blindly following the herd over the cliff. The myth that the market is always right is a dangerous fallacy. The market is simply the aggregate of individual decisions, often driven by emotion, speculation, and misinformation. True wealth is built not by blindly following the crowd, but by cultivating independent thought, by challenging conventional wisdom, and by seeking opportunities where others fear to tread. This is the essence of contrarian investing, identifying undervalued assets that are out of favor with the market, companies that are overlooked or misunderstood. It requires courage, patience, and a willingness to stand apart from the herd. The herd is a stampede, a mass of bodies moving with a single, unthinking impulse. It may seem powerful, even unstoppable, but it lacks direction, and it can easily trample you underfoot. Are you a sheep, blindly following the flock, or a shepherd, guiding your own path with foresight and conviction? Imagine a ship, its anchor firmly lodged in the seabed. It can drift slightly, sway with the current, but its movement is ultimately restricted by that fixed point. This is anchoring bias, the invisible chain that limits your investment vision. It's the tendency to cling to the first piece of information you receive, even if it's irrelevant or outdated. In stock valuation, this often manifests as fixating on the initial purchase price or a past high. You bought a stock at $100, and even though its fundamentals have deteriorated, you're reluctant to sell below that anchor, hoping it will return to its former glory. The belief that price is always right is another dangerous illusion. Price reflects market sentiment, which can be fickle and irrational. True value is determined by fundamental analysis, understanding the underlying business, its competitive advantages, and its long-term growth prospects. To break free from the chains of anchoring bias, practice zero-based thinking. Evaluate each investment as if you were starting from scratch, without any preconceived notions or emotional attachments. Ignore past performance, disregard the initial purchase price, and focus solely on the present value of the asset. Anchoring bias is like being chained to a fixed point, preventing you from exploring the vast landscape of investment opportunities. Are you willing to cut the chain, to break free from the past, and to navigate the market with a clear, unbiased perspective? Imagine yourself in a room lined with mirrors, each reflecting your own image back at you. You see yourself, your beliefs, your assumptions, endlessly repeated. This is the echo chamber of confirmation bias, a psychological trap that reinforces your investment mistakes. Confirmation bias is the tendency to seek out information that confirms your existing beliefs, while ignoring contradictory evidence. You've decided a particular stock is a winner, so you selectively read articles that support your thesis, dismissing any negative news as irrelevant noise. The common advice to do your research is well-intentioned, but it can be easily subverted by confirmation bias. If you're not actively seeking out opposing viewpoints, your research will simply reinforce your existing prejudices, leading to overconfidence and poor decision-making. To escape the echo chamber, embrace the devil's advocate technique. Actively seek out dissenting opinions, challenge your own assumptions, and force yourself to confront the possibility that you might be wrong. Read research reports from analysts who disagree with you, listen to arguments that challenge your investment thesis, and be willing to change your mind in the face of compelling evidence. Confirmation bias is like living in an echo chamber. You only hear what you already believe, reinforcing your biases and limiting your understanding. Are you willing to step outside the chamber, to confront uncomfortable truths, and to cultivate a more objective perspective? We've journeyed through a landscape of hidden dangers, exploring the psychological traps that can derail even the most disciplined investors. From the seductive whispers of overconfidence to the paralyzing grip of loss aversion. From the blind stampede of herd mentality to the invisible chains of anchoring bias and the echo chamber of confirmation bias. These biases lurk within us all, waiting for the opportune moment to strike. But knowledge is power. By understanding these traps, by recognizing their mechanisms, and by implementing the practical techniques we've discussed, you can build a robust defense against their influence. Self-awareness is your first line of defense. Critical thinking is your weapon. Data-driven analysis is your shield. Commit to a practice of continuous learning, of relentless self-assessment, and of unwavering objectivity. Challenge your assumptions, seek out dissenting opinions, and be willing to change your mind in the face of compelling evidence. Warren Buffett has often said that temperament is the most crucial quality for an investor. It's not enough to be intelligent, to be knowledgeable, or to be skilled. You must also possess the emotional fortitude to withstand the inevitable storms of the market, to remain calm in the face of adversity, and to resist the siren song of irrationality. Mastering your inner investor is a lifelong journey, a continuous process of self-improvement and psychological refinement. It's about building resilience, about cultivating discipline, and about developing the emotional intelligence to navigate the complex and often treacherous world of finance. Are you ready to commit to this journey? Are you ready to face your inner demons, to challenge your biases, and to build the psychological resilience necessary to achieve long-term investment success? What will you do differently starting today?